And the other thing is, at the very end of the year, we had a very big Series A announcement. Well, not announced yet, so I won't name the company, but we had a very big Series A that is taking place, that is still wrapping up right now when we're taping. So, I won't mention the name, but it's our second Series A from the fund that's closing. You have a few more in the works. That's closing, and it's a company growing extremely quickly. They went from 0 to 10 million in ARR in around 14 months, which is also quite impressive, and allowed by the AI that they're using. It's a 4.5x for us. We're having a 4.5 markup only in 9 months. So we invested in this company at the beginning of the year in March. And then in December, 9 months later, we're at 4.5x. The company, what's interesting as well is they're still growing at 40% per month. They're growing at 40%, even at 10 million AR. And of course, the Series A is led by a very prominent tier one firm. So very exciting on this specific startups front. But the portfolio overall is doing extremely well with the 10 markups already. And obviously, we're going to have many, many more in 2026. So what a crazy year. We're, nearing the, I should say we're done with deploying Fund 1. I mean, we have a few more checks in us that we're going to be deployed in the next few weeks. But by the time this airs, maybe we're going to be done deploying with Fund 1. And so obviously shifting our focus to Fund 2.
So yeah, and it's great to kind of see those Series A's coming through, especially with press releases when they get announced too. And this is kind of one of the main theses around investing in YC, because 40 to 45% of YC startups reach Series A, which is above the, I think it's like 32% market seed average for seed stage. So it's almost like a 50% increase in survival odds for like YC companies going to Series A. But obviously, as a early stage investor, just getting to Series A is not the goal. And so one of the big sort of predictions that people are talking about across 2026 is it becoming like a record year for liquidity. Obviously, we've heard a lot of talk about SpaceX, OpenAI, Anthropic, Stripe, Databricks, like all of those companies potentially IPOing, which is a huge amount of capital, probably around maybe upwards of $1 trillion of capital getting unlocked there. And then that kind of hopefully will be these like floodgates of this like 4 or 5 years of drought breaking out. And so yeah, but that isn't the only liquidity that we're starting to see in the market too. So I'm really keen to kind of get your thoughts on what you're seeing with YC companies, because with the rate of growth we're talking about there, that particular company just growing in revenue so fast, it actually is starting to mean that acquisitions from an M&A perspective are starting to happen a lot faster as well. So yeah, just be great to get your take on the ground there.
Absolutely. So many great points that you're bringing up here. First of all, what's interesting here is the speed. YC companies reach Series A at a higher rate. There's more of them, but they're also doing it faster. Seed to Series A in 9 months is really fast. It used to be 18 to 24, and that was 18 months was for sort of the best in class. This is half. This is 9 months. So that's one thing. There's more companies graduating to Series A, and it's happening faster. Also, a lot of investors consider that Series A really is the de-risking point. That, of course, seed companies, everyone knows the mortality rate is extremely high. Once you actually graduate to Series A, it's not an IPO yet. Still, some companies can die, but your odds of making it are significantly greater. And of course, there's Series A and Series A. If you raise 1 or 2 million Series A with an obscure lead investor, maybe your odds of survival are not that great. But if you're raising tens of millions, that's the case of the company that we're talking here, several dozens of millions of dollars with a tier one, then obviously your odds are much better. It's this saying, I think you and I just talked about this earlier. I'm not sure if it was on this podcast, but if you reach 100 million ARR in 4 years, why would you wait 12 years to IPO? Like if you reach it in 4 years, you can just IPO the 5th year. And by the way, you don't need to be at 100 million AR to IPO. You can IPO at 50 million AR. And of course, you can wait to have more revenue. But that 8 to 12 year thing was because it was taking so much time for those companies to be IPO ready. And of course, the market at some years was not ready at all. If you're wanting to IPO in 2023, maybe you're ready as a company, but the market wasn't ready. So in 2026, we have the market is super ready. It's like you said, we have a backlog, and we have companies reaching 100 millions of AR super quickly. Again, this company from our portfolio that I'm talking about, 10 million AR in just over a year, growing 40% per month. It means they could be at, several dozen, again, like closing in on 50 or 100 million of revenue, even at the end of the year in 2026 or in 2027. At this point, if they want to IPO, they probably could. So this all ties into liquidity. And I'm so happy you brought this up because, I talk to investors all day long. It's, my job is talking to investors as potential LPs in the fund. And of course, talking to entrepreneurs, founders as potential investments. And liquidity really is the name of the game. I've also been lucky to have that discussion with Barry Eggers of Lightspeed, the founder of Lightspeed. And, we were talking about fundraising and techniques and what matters, etc. And, it's funny because we've been talking for a few hours and he always comes back to, hey, listen, you can do whatever you want. You can have whatever technique, you can have whatever angle, you can have whatever marketing. At the end of the day, the only thing or the most important thing that matters, and he's raised, I believe, 17 or 19 billion dollars and across dozens and dozens of funds. At the end of the day, the only thing that matters is DPI. And so DPI is, giving money back to your investors, distributed to paid in. And that's through liquidity. It's the name of the game. Some VCs forget you're here to actually give money to your investors. So liquidity is sort of the number one thing on everyone's mind. 2025 was also interesting for Lobster Capital. I was sort of doing a little recap earlier because we had our first liquidity and we sent money back to our investors. A fund that's 2 years old, sending money back to investors. And it was small, obviously, right? It was not a big amount. It was through a very, very small exit of a company that shut down and gave us back the money. But still, it was a gesture to say to our investors, hey, we take liquidity very seriously and we want to give you your money back. So we've talked about this so many times. AI is accelerating everything. If you're going, reaching 100 million, why wouldn't you exit sooner? And we talked about IPO, but it could be acquisitions. We've predicted, you and I, on this podcast, more than a year ago, I believe it was more than a year ago, that AI was going to bring liquidity back. It's been one of the predictions that I've been, the most proud of because now it's true. And at the time it was not consensus. Now a lot of people are thinking it. And it is happening. Maybe 2025, there's still maybe a lagging indicator a little bit. It was still catching up. But yes, I believe liquidity is coming back. And that's very, very good news for VC. VC as an asset class gets a bad rap for two reasons. One, there's a lot of people who shouldn't do VC. If you're doing VC in Europe where there's no IPO market, where there's no stock market, when there's no exits and M&A because you don't have big tech giants, then those VCs in Europe don't perform well. We're both from Europe. We've talked about this extensively as well. But if you do it in Silicon Valley with AI, I believe, that was the first reason that it doesn't get a bad rep. You have to do it at the right place. You have the IPO market in Silicon Valley, you have the exits. And the second piece is there's no liquidity in the last, 5 to 10 years, almost 10 years. And that's a big problem as well. If liquidity starts coming back, the VC asset class is going to be exploding. And that's my prediction for 2026. People are going to come back to the VC asset class. Right now, everyone wants to do, late stage secondaries or private credit or stuff like that because it's liquid. And VC wasn't. If VC becomes liquid again, obviously it's performing better than, in terms of returns, rather compared to those other things. I think VC is going to come back as a trend. That's good for us. That's good for YC. We're positioned as investing in the best startups of the best incubator of the world, purposefully, intentionally. It's great news for everyone. It's great news. And so, mostly for our LPs. But of course, if our LPs are happy and benefit, we benefit because, we make them happy. They want to reinvest in the fund. So it is happening.
And so some of what we're seeing as well is actually like there's increasingly creative ways for this liquidity to come about, partly because of things like regulation. But we just saw last week the Grok acquisition by NVIDIA, which is, on paper like a licensing kind of acquihire in a way. We also saw the same thing happen with Meta and Scale AI, Windsurf as well. And actually, another kind of backing of the thesis around selecting Y Combinator companies is when you are kind of pre-filtering for talent in the way that YC does, and you're selecting people that are moving very quickly or working really at the edge of a lot of AI, those startups are going to be a lot more likely to experience the acquihire kind of lens of these companies coming in. Like Scale is a very good example of that coming out of YC. So I think that's the other thing here is like there are going to be increasingly like almost creative ways. Secondaries is obviously one that you've talked about, but the other one that's coming up a lot is around how sort of private equity is increasingly confident and kind of ready to deploy capital, especially in the middle of the market where they think that there is like this real play to roll up companies to add in AI efficiencies. And actually the same attitude is kind of creeping into the VC market as well. We talked earlier or on a different episode about how, you know, General Catalyst has this new AI roll-up strategy. Some of that as well is going to create this more liquidity for these early stage companies, especially those aligned with some of the thesis that Lobster's looking for, where you're taking a concept about an industry and just rebuilding it in this AI native way as well.
Absolutely. I mean, by the way, the company that I haven't named that's just executed their Series A that's doing extremely well, that's exactly the angle they're going after. They're taking a legacy industry, rebuilding it from the ground up, AI first, AI native. And, you know, the floodgates have opened or the cat is out of the box. You can look at any legacy industry and rebuild it from the ground up with AI. And YC actually has been very early in this. They said this as, I think, maybe almost 2 years ago at the beginning of 2024. Be like, take any industry, take any company and rebuild it AI native from the ground up and go compete with anyone. And you can just literally compete with anyone. And so what's really interesting here is we've seen a lot of people, and that's also in my YouTube video on the predictions of 2026. So that's on the other channel. You can find it. It's called Lobster Capital. This is the Lobster Talks. If you find Lobster Capital on YouTube, is sort of a PE and VC getting mixed, getting intertwined, and sort of VC is kind of eating PE. It's sort of, if there was a war, VC would be the one winning here. And that's because what is PE intrinsically? What have they been doing for the last, 200 years is acquiring companies, consolidating, usually, having several companies, several smaller companies brought into one bigger group, and then trying to have economies of scale, trying to, consolidate how they do business under one roof to just cut cost and increase efficiency, and at the end have a bigger group that you can then sell. That's been one of the major plays of PE. The thing is, AI changes the rules entirely, because in legacy industries today, I mean, it's so much easier to replace people with AI processes, with AI agents. And so instead of cutting your cost by 10%, for those things, you can cut your cost by 100%. Or, 99%, you just pay for the AI agent or for a developer. People used to have an HR person that writes job descriptions and then filters through CVs. And then if you ask any CEO today, they just, the job description is written by an LLM. And then they also have an AI that's filtering through CVs to rank them by order of the most, efficient for that job. And that's it. So this job is just disappearing. And that's across almost every company in the world. So the opportunities for companies in 2026 are insane. It's something I retweeted recently. It's not from me, but I retweeted it, that for any entrepreneur that's looking for a company to build, go through a list of PE acquisitions, recent acquisitions, and just build the same thing. So there's two things. You can sell to PE. And again, in terms of acquisition, right? Instead of selling one by one to your customer, you can sell to the PE company that's going to mandate every single one of those companies to actually use your tool.